Well, coming into this trading session, we have seen the Canadian market higher so far in 2024. However, we are once again trailing the American market, where the S&P has rallied about 6%, call it triple the advance we've seen in Toronto. And remember, that was a similar theme last year. S&P up, call it 24%, again, basically triple what we saw for the Canadian market. A lot of that has to do with the makeup of these two key benchmark indices. But what does the road ahead look like? Well, we're here with Philip Petursson, Chief Investment Strategist at IG Wealth Management. And Philip, I guess regular viewers will know a lot of this has to do with tech's outperformance. Is there anything more to the story about Canada versus the U.S. on the equity side?
Yeah, there is. When you think about Canada, you have to think about oil. Historically, the correlation between oil prices and the movement on the TSX is quite high. So we think of oil just as the energy sector, but it reaches into other sectors as well. It gets into industrials, it gets into the financials. So our outlook for oil, as you mentioned, oil's been stuck in this range. We're seeing increased supply to the United States. OPEC continues to cut, but how accurate the reporting of those cuts are remains to be seen. Nonetheless, we are oversupplied globally right now. So if we're in that position, oil prices are going to continue to be stuck in this range, which means the TSX is likely to be stuck in this range, and earnings growth for the TSX then is going to be much more muted than what we see in the United States.
And just to remind our audience, we talked about banks earlier. Financials and energy together are pretty much on the doorstep of representing half of the entire index. So exactly. You have to have a relatively, is that fair? You'd have to have a pretty constructive view on banks and energy stocks if you thought the TSX was going to see notable outperformance. Exactly.
You have to have a bullish view on both energy and the banks over the United States, what it can deliver in order to be overweight Canada vis-a-vis the U.S.
Now, the other thing out there, and, we just went through earnings season, so we have fresh numbers to work with when you're trying to value companies. But I think there's been this storyline about tech's huge run-up and whether or not the valuations on those companies as a result of that run-up look fair to people who are looking for reasonable valuations. And there's this case that's often made for Canada because of that outperformance by some of those U.S. technology names, that there is some value in the Canadian marketplace. What is the determining factor, though, when one wants to unlock value? Like, what kind of time commitment do you have to be willing to make?
Exactly. Time commitment, and also what is the catalyst to unlock that value? So when we talk about banks in Canada, one of the catalysts for Canadian banks is the Bank of Canada and cutting interest rates. So if we see interest rates start to come down, well, that could unlock some of the value that we see in the banks, and you could see the banks re-rate higher. In the United States, though, the catalyst is earnings. These companies, these mega cap tech companies, which I've been a little bit more cautious on in the past because of the valuation, they continue to surprise to the upside in terms of earnings. It's not like the dot-com era where companies moved higher on hopes and prayers. These companies are delivering on the earnings, and those earnings are being rewarded with higher valuations.
Now, I had a segment last week where we talked about, because look, a component of our audience is investing in companies that will pay them today, as they also obviously want some appreciation for tomorrow. And there's no short list of companies that make up the TSX that have some pretty attractive dividend yields. And actually later in the program, we're talking about some companies that are projected more than others to boost their dividend over the next few years. But again, that idea of being able to lock in capital today through things like dividends, can that help to make up the difference if the overall, let's say, S&P versus TSX shows better performance for the U.S. markets?
It'll make up the difference in terms of current income today if you're not a heavy trader and trading your U.S. portfolio and taking profits. Also, you have a tax advantage with Canadian dividends. And as you point out, Canadian dividends are higher than what you see in the United States. There's some fantastic dividend-paying companies in Canada that have shown to be able to grow their dividend at above average rate over the last 5 or 10 years, and they tend to be rewarded as well. So, when we talk about positioning between the United States and Canada, it's never all or nothing. It's always a positioning of scaling in or scaling out. So in Canada, you want to focus on those areas of the market that will reward you. So high dividend payers, high dividend growers are a great strategy.
And sector-wise, are there any conclusions, the areas you feel the best about going forward?
Actually, within Canada, even though we're underweight overall, we do like the banks. We like some of the industrials, like some of the consumer discretionary companies. I would probably shy away from the interest sensitives on the fact that, we're interest rates, while we think they're going to come down, these areas tend to be a little bit richer.
And that would sort of echo some of the flows that we've seen this year. Industrials are doing pretty well. Utilities, which those are rate-sensitive names, presumably. They've been lagging a little bit. For the fixed income versus equity equation for investors, what's top of mind for you right now?
Well, here, when we look at the macro environment, we see a higher probability to upside or a positive return for Canadian stocks, U.S. stocks. And then our downside, our bear market scenario, isn't as bad as what you would expect in a recessionary environment, which we're not in one right now. So fixed income, we see it as a nice neutral position in a portfolio. Maybe down the road, if we continue to see strength coming out of the U.S. and global economy, that could be an underweight. But for right now, you're clipping a coupon of between 4 and 5%. It still offers decent downside protection in the event that the whole world's wrong and we fall into a recession. And so it's worthwhile having, but being overweight fixed income at this point probably doesn't make a lot of sense.
Only about 30 seconds left, but I was talking about Bitcoin running up earlier. Bitcoin versus gold is, something people are curious about sometimes, just as sort of trading an asset class. But I ask it in the context of the Canadian market because materials make up close to 10% of the TSX. Do you have any view on what happens with the price of gold? I would assume the direction of a currency like the U.S. dollar has to be one contributing factor.
It is. If U.S. dollar strengthens, that's a headwind against gold. But if real rates start to fall, gold should start to do a little bit better. My view between Bitcoin and gold: gold's a currency held by central banks around the world. Bitcoin, I struggle to attach a valuation to it.
It's a conversation.